Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, August 29th, 2024. It's 10:02 Eastern Time as I'm starting the video. So we're exactly 32 minutes into the trading day to be exact. What I'm going to do in this one is kind of try to hit everything. When I say everything, the things I've been focused on lately. Oh, let me add to my list. I want to update wheat also, cover on that. Okay, so here's what we're going to do. And I'm going to try to stick to it in this order. Quick overview on the equity markets. That'll segue into NVDA, which is to me just about everything right now to the market, I believe it is. I'll do brief updates on crude and natural gas, gold, silver, the dollar, and the euro. I just added wheat on that list. And then time permitting, I'll hit some of the individual trade ideas that I've thrown out lately, individual stocks. After this video today, there's a couple sectors I want to highlight too, and I'll do, as I usually do when I'll do a sector, I'll drill down. We'll look at the sector itself via the ETF or any ETFs that it has, and then drill down to some of the components. Okay, starting out here, QQQ. Today is one of those days I'm just kind of sit back. I'm not going to react to much of anything and see how the day closes. This is a daily chart of QQQ. You can see we still have the PPO down here flirting with the zero line. That helps to delineate bullish and bearish trends. There was a bearish trend there, sideways to down. We had a correction there, and that PPO was under the zero line there. And so far, we're back testing. And what I always look at, I like to use that 9 EMA, the signal line. It's the last of the two to cross, so you have fewer whipsaws there. So we'll watch that. That's what it looks like here on the daily chart. So far, unless things change, I'm going off the working thesis that bearish engulfing candlestick from July 11th marked the top, and that this was the first leg down to hit my second target in those 200-day moving averages with a bounce. And look where the bounce stopped so far, right at the bottom. Remember the market top range I laid out in late June before we even hit the top. We were below it and said this is where I suspect the run will end, and then we'll start a new downtrend. And so that's still what I'm going off of. We checked the 200 days, we bounced as expected, and the next big sell signal is going to be when we undercut those in those recent lows. And now we still can't rule out, as I showed you the other day, yesterday, the day before, a potential bull flag pattern here, bullish pennant. Right there, actually more of a bull flag shape, and that takes this move up as a flagpole, that being the flag, and this is the measured target. You add it to the lowest part of the flag before it breaks out. I put low probability of that playing out that way, but something to watch and monitor. We're trying to crack that level right now. Let me drop down to the 60-minute charts and I'll show you. And also, as I said before, I'm not reacting right now. I'm just kind of letting the dust settle after NVIDIA earnings. As I said, you tend to get a lot of volatility, and we certainly saw that in the after-hour session. The first spike was up. The second spike was down, and NVIDIA is still red on the day. In other words, it went red after earnings, stayed there, despite the fact they blew it away. Like I said, you would have to almost be a fool not to bet or expect that they wouldn't beat earnings. These companies, billion-dollar, actually trillion-dollar companies. Let's say they have a managing earnings and guidance down to an exact science. So rare that they ever miss. And again, it's not about what the results are. It's about the market's reaction. So far, they've been selling NVIDIA, and so we'll watch how that one closes today. So what I have here, as you can see, this is just to recap. We had a divergent high recently here. This was the top there with the bearish engulfing candle, sell signal in the break of that small wedge, secondary sell signal, third trend line break and back test, and that whole move there that we covered the lows, reverse, went long there, and it looks like we've come full circle with the divergent high. Then we broke this trend line here. We had a minor trend line break there, and then the more significant one, and we're still below it. So that's that, and you can see here, and I changed the color to yellow. I've had these, if it should push up anytime soon, and it doesn't guarantee it reverses, but it guarantees, again, anytime soon, meaning in the next week or so, if we equal or take out with just by a relatively small margin that previous high, we'll have nice big, and even the kind of divergence I really like to see for a trend reversal, which is clean separation in the indicators. In other words, this was divergence. You had lower highs there as we were walking up higher highs on prices, and you can see the divergence in the RSI. But you know, the ideal divergence gives you these clean troughs, if you will, between the on the indicators, and you come up, and that would be if I'm just extending out the divergence lines. Again, it would have to happen in this manner. If it zigzags and takes a while and we grind around sideways, things may look different. You know, there's an example of clean separation in indicators. So, but as of now, that was a divergent high. This was a counter trend rally, I'm viewing it as, and so far, this is the trend line to watch today. We popped it right now on the opening 30-minute candle, and we haven't had a full 60-minute candle yet. This is our next candle, and that's going to finalize at 11 p.m. So either this will be a breakout of this downtrend line off the highs. You can see all the reactions. If you want to duplicate it, make sure you use log scaling if you're replicating my charts. And if you're trading in general, I highly recommend log scaling over a lot of charting platforms. Will default it to arithmetic or linear scaling, which are the same thing. All right, so that's a trend line right there that, you know, if they can clearly take it out, then you can see the next resistance levels overhead. And I already laid out what it could look like if we get a divergent high. We could go up about another 3% or so to get it, depending if and when we get there. And if we fail this breakout and close down today, especially if we take out yesterday's lows on the wake of NVIDIA, that's going to trigger the next wave of selling. So those are your levels to watch, guys. So I'll make it simple. 467.76, roughly, give or take, whatever yesterday's lows was. And obviously a solid 60-minute close above this trend line, and then each of these resistance levels overhead. So that's what the market's looking at. That is QQQ. When we look at a 60-minute chart of SPY, you can see the same thing here. We put in recently, that was a divergent high. It was the high. This was the next 60-minute divergent high that we've had here since that one last there. That last one was followed by a drop. You came with the sell signal on the little wedge break right here. The total drop from that divergent high down to the low. Again, it doesn't include the pre-market swoon, which was deeper. That was almost 10% there. So here we are. All I can tell you definitively, we recently just put in a divergent high on the 60-minute chart. This is now the trend line to watch. You've got 1, 2, and now 3 distinct reactions to help validate it. And same thing. And it almost feels like, based on just the posture, the MACD, and everything, that you might get that one more thrust up again to give you that clean separation and nice, you know, kind of what I call textbook divergence. And that would be, again, a marginal new high of about not even as much on SPY. So what you'd be looking at if it happens is, I just drew it out, a little outperformance over the next few sessions in the tech heavy NASDAQ 100, relative outperformance relative to the S&P 500. I'll touch on the small caps real quick. This is IWM. The 60-minute chart also put in a divergent high there, followed by a drop of 13.5%. This is the most recent divergent high. Talked about this level being a level right there. We broke it, and there was also a clean uptrend line off the lows, which we broke. And you can still say we're back testing from below, because this candle again won't finalize until 11 a.m. today. So we've got about another 50 minutes. And all I can tell you, we have some minor resistance right here too. You can see this gap right there. There's your gap. All these candles right here. So this is going to be near-term bullish, probably give you more upside on the small caps, whereas a rejection would be a breakdown and a back test following that divergent high, bearish. Like the big caps, any new marginal new high, again, it has to be marginal, meaning just, you know, not too much above the previous high followed by a reversal, would also simply just extend these divergences that were already in place at this most recent high. So there's your update on the indexes, key levels to watch. You can see here IWM for support. If we do get rejected, next big price supports at about 25.10. Okay, I was on the 60-minute charts there, so I'll stay on that time frame for now. NVIDIA, last short trade here, first, second, third target hit with a reversal, and then most recently we've come full circle with another divergent high. As mentioned, pre-earnings just before the earnings we broke down. So far that breakdown is very much intact, and the thing is earnings are now out of the way. So that's why today to me is a kind of interesting day. Sit back and watch and see what happens. A lot of everything else, all the other top stocks in the NASDAQ 100, even all the semis I'm looking right now, all the semis are green except NVIDIA. But again, this bears repeating. To me, NVIDIA is the only thing that matters right now. I know it might be a little bit, I might sound a little facetious, or that might be an overstatement, but I think the psychological weighting of this one is just about everything. It's the undoubted, undisputed king of the AI bubble. And so we'll see how this one goes. If this proves to be a whipsaw and they gobble it up and they take out the previous high, and what they need to do too is, remember, this was a bearish rising wedge pattern, which is broken down. Earnings are now out of the way. So any back tests would still offer an objective short entry. However, a recovery, solid recovery back above that uptrend line would be bullish. You're also going to start taking out previous highs. Right now we have a downtrend in NVIDIA from this high. A downtrend is simply defined as a stock making lower highs and lower lows. It's quite a ways down before we take out that previous low, but as I said earlier in the video, same with the indexes, an undercut of the recent lows, in my opinion, won't just open the next wave of selling. It'll open the very impulsive wave of selling, the kind that you don't want to wait a day or two to get short if it happens. In fact, if you get anywhere near those lows in the market and these key stocks like NVIDIA, I think you'll just see the floodgates open. So I'm laying out a scenario if and when we get there, guys. So trade it as you want. Right now, there's a lot of stuff up green today. I'm just focused on the ones that matter. And so I've seen this movie play out and time again, be it Apple in the past or another big tech stock where everything else was all giddy and rallying, but then you had a clear technical, bearish technicals, and a lot of those stocks tend to top on positive earnings reports. This one's already peaked, so we'll see. So that's the $1 million question. Where does it go from here? I haven't modified or changed or tweaked my targets. This is for the long-term swing or trend trader. T1 was hit here. We covered reverse, came to bounce. Now next move down would be T2. If we get down there, again, because of the way I talked about undercutting the recent lows, that's why my thoughts are that we could potentially have very little, if any, reaction at T2. Again, if we get there, I'm getting 10 steps ahead of myself right now because we're right now I'm more concerned, do we take out, here's that downtrend line off the highs on the video. We pop that, you can see it's pretty clear. And this is a daily chart, or no, weekly chart. 1, 2, 3, 4, we're fourth weekly test this week on that trend line. Let me see how it looks on the daily for you. There it is. There's it on the daily chart right there. You have the recent highs. So pretty much, again, we just popped these highs here. It may want to run. Watch for a bearish PPO crossover. That is a pretty good trend indicator. And so those are the things I'm watching in the market today. There's 101 other things too we could talk about, but the video will go on forever. So now let's move on to crude oil. Crude has been very, very tradable lately. We had a long here right at the lows, exit it there, final target, get out, and or reverse drop. I mentioned it last time as a short here to here from this resistance level zone. Same when we sold it there to there. Got a huge pullback there, put in a divergent low, rallied up. And just the other day, I mentioned it again as another objective short entry. Told you I was leaning towards, because we didn't have divergence at that high or anything, quick pullback trade. And for those of you that took it, again, not that you milked every penny of it, but about a 5% drop off that last rejected off the downtrend line as expected right there. And it's powered back up. All I can tell you is that's still resistance. However, I wouldn't be surprised. It keeps coming in and it keeps making these higher lows, and it could punch up through there. So we're going to talk about crude just a bit more on how it might impact the market. You may remember going back earlier in the year, I laid out zones for both the 10-year Treasury bonds as well as crude oil. I haven't talked much about either lately, other than the fact that with the crude short, that the orange zone, the bottom of that is 79. That is resistance, and that also helps support a case for the short on crude there. So here's crude oil. Crude oil has a clean uptrend line. It keeps making higher lows, and it remains up here. And I haven't talked much about it because crude, inflationary forces, and crude being the biggest one of them, or one of them has abated there, and so we've been in the yellow zone. And these zones mean what they mean to the market. And as I've covered in the past, when we got here, I warned of it being in the orange zone. I'm sorry, it entered the orange zone, and we had at that point in time one of the biggest drops in the stock market because of it. The stock market finally got the memo, and it's the same thing right here. And here I'll show you if you're not sure or you didn't catch it before. Just we could put on QQQ USO, so you can see there's the drop in QQQ. And the second drop, and those are big drops. Remember, those are double-digit drops there. It doesn't look like much when you use this overlay tool, but both of those coincided. So that's what I'm watching here, guys. And if we take out that downtrend line, we're going to get back into the orange zone. The last 2 times we got in the orange zone, without fail, we had the 2 biggest corrections over the last year. So that's something to watch right now. More of I'm watching it than at this point in time trading it. Natural gas, throwing that out lately. The last trade idea, and we had more targets that have yet been hit, but this was a target. Remember, on the futures, they roll, and they roll. Natural gas is rolling every month. Your stock futures are going to roll quarterly, so I can use the same charts for 3 months. This guy's rolling every month, and you got pretty much this support right here. This is the last place we bottomed. We put in positive divergence. These are, like I said, I have to. When these charts roll, all my lines and levels go away. Plus, they change anyway, so you have to do a new chart. So we had a breakout there. We hit, I can't remember what number that was, T2 or T3 with a divergent high. We've come back, and we're back to the previous lows. We also have positive divergence. So you can take a shot here. And you had a little minor downtrend line, little wedge we just broke out and back tested. Often what I've noticed when you get down, you test these lows, it's just the algos and the nefarious forces in the market. They love to punch it down through their clear stops and then load up on those themselves long on the stop raid. So you might want to be open to that. And again, it can be a new trade idea. It's a new futures contract or an existing one. UNG, remember, does a okay job, but can't do a perfect job because it's an ETN that's rolling futures. But you can see we're also down to the same, pretty much that same divergent low right there. And if you look at it this way, the divergence has only grown larger now. We can make a equal, I mean, we're close enough, but an equal or slightly lower low, as long as it's only slightly lower, will give us a even bigger divergence and then open the door for these higher targets. So, and remember, we're also flirting with long-term support on natural gas futures, as I've covered recently. What did I say next? So gold, GLD. So gold, we know, has a pattern of making these, as I've talked about. It's in an uptrend, but it's not a very powerful. It's a grinding uptrend, and we've had this pattern. It's been, as I mentioned, very tradable. We've had numerous trades, long and short, off these divergent highs. So the pattern, the MO is it makes a marginal new high. It's a divergent high on the 60-minute chart, and then we correct. So this one, like I mentioned, still divergent high. As I've been telling you for a while now, I don't have strong convictions. I get asked for updates, and all I can tell you is, like I said, it's more to me a trading vehicle. Gold doesn't pay dividends. So when you're in this multi-month trading range, if we do correct, if the pattern continues and we correct off this divergent high, each of these other corrections have brought you down, towards the bottom of this trading range, or at least the midpoint, then it puts you right back to where you were in April, So that's been the kind of the grind lately. Breakouts to new highs usually should see some buyers come in, and we're not seeing that. So it's not going down much. Again, that's it. So there's a trend line you can look at to trade. All I'm trying to say is maybe buy it on the next pullback to support. Here's an uptrend line if you're looking to get into gold. I just think there's better fish to fry elsewhere. And of course, it makes a part of a diversified portfolio. Silver, I'll get to the futures in a second. I do want to look at those. Silver, as I mentioned back a few weeks ago, looked better than gold to me. It had a positive, nice divergent low at support, and but it's rallied into that 2746 resistance level I've had on the chart. Does also have, you can see here, negative divergence right now for the first time since this time. Here, let me just make it complete. Copy that, put that there, And it's a wash, rinse, repeat situation. Divergent high, correction, divergent high, correction, divergent high, correction, divergent low, rally. That was a divergent low right there, at least on the PPO, and you had a rally, divergent low, rally. You extended it. There's a case where, make divergent low 1, but the divergence gets bigger, bigger rally, divergent high, divergent low. All right, you get the point. It's wash, rinse, repeat, guys. It's a good trading vehicle more than a buy and hold right now, in my opinion. And with these divergences, the next move is probably to the downside. To help support that case, as you remember, I think it was last week, I showed you bearish setup in the euro, bullish on the dollar. This 60-minute chart, we put in a divergent high. We've now broken this trend line. This is EUR-USD, the euro-US dollar pair. I also showed you on the daily chart, we were coming up to this previous reaction high. We had a resistance level here. There was a breakout of these primary downtrend lines, but again, we hit resistance. And more so, here, I'm going to show it to you on FXE. I know there's always new folks coming to the site. So FXE, this is, although it's not labeled, this was a divergent high, just like this was a divergent high, and that was a divergent high, and there was a divergent high there. I usually chart EUR-USD, so all the annotations aren't on here. And, and these are plenty of divergent lows here, that caused or the catalyst for the rallies. And so the takeaway is when you can do a comparison at a chart properties, there is a strong correlation between the stock market and the euro. The euro is basically the dollar in reverse. I think you can see these lines. The purple is the S&P 500. When the euro rallies, the S&P 500 rallies. When it turns, euro peaked first, then the S&P peaked and followed it down. Then they were both rallying, right? And there was a period of brief disconnect there. Those periods of disconnect usually end with a mean reversion. Correlation returned, and then the S&P had the biggest drop in a while. And you can see, again, the correlation's very tight. The only thing missing is the euro has clearly turned, and didn't just turn. It'd be one thing if I showed you, with a random chart, that, oh, it's going down. No, but it broke trendline support, put in a divergent high. So this indicates to me more downside in the euro. So the S&P and NASDAQ 100, they usually don't follow right away. But if that continues down, so again, something to monitor, the market will most likely play a game of catch up. And again, the charts indicate downside on the currencies. The euro, U.S. dollar, you can look at UUP. That's everything in reverse. So then you have an inverse correlation, that way. And you can see the dollar. Let me show you the futures. They're more clean in my. This is DX. DX are your your US dollar index futures. And so here you had a bearish rising wedge. Trade well to the technicals. There was a breakdown, back test. If you missed it, you could have, if you missed the short there or you took a starter, you could add it on the back test and you caught this whole move down. And then it told you to cover here when you started seeing the positive divergence, indicated a trend reversal was likely. You hit support, bounced, and that rally ended with, you got it, negative divergence. Set up this drop here that went all the way down here until you had a big old fat divergent low, which I highlighted for you last week. We got a breakout, came in and back tested the wedge, put in a marginal new and still divergent, even bigger divergent low, and we've been moving up. So with the dollar futures, you want to see a break of about 101.50. That'll take us up to my next target, 102, about 102. And then if we go up there, by this point in time, if that happens, the stock market should have gotten the memo. If it happens. So again, something to watch or trade if you want. E7 are your, if you want to look at the dollar upside down, look at E7, that's Euro futures. And Euro futures put in a divergent high, broke this first trend line, and now just broke the secondary trend line, and we're at that 1.1065 target right there, support too. So if that breaks, it brings us down to the next level, and at some point the stock market will begin to get the memo. Oh, and gold too, by the way, guys, I didn't do it. Gold is also highly correlated to the euro, inversely correlated to the dollar. So same story there. So if you're a gold trader or whatever, or forex trader, these are the things you want to watch. Okay, told you I'd give you an update on wheat. wheat just, keeps putting in these divergent lows, and it does rally. They're just good for little trades, and then the downtrend continues so far. Yesterday, we effectively came close enough in that T1, but it's really R1. I wouldn't be covering there, closing out, taking profits, because that was what comparable. I give you R1 on the wheat ETN. So those are still the same target. Bottom line, we're still off that divergent low, walking up. We need to punch through T1, we'll call it R1, but 545 and 3/4 to open the door to move up to these potential targets. And then if you are an ETN trader, let me turn off that comparison right there. ETN trader, you go with WEAT. And so that's it. So I'll give you it here on this breakout, put in that big divergent low, rallied up. It's got to get through R1, meaning first resistance, and you have a minor secondary downtrend line right there, and that should open the door there. So again, not super crazy about it, but every time we keep getting these divergent lows, they're good for a little rally, and the divergence gets bigger and bigger. It shows through on the daily and I believe even the weekly chart. So one of these seemingly innocuous divergent lows will probably be the one that triggers a trend reversal. Remember, you also have, for the first time in forever, the hedge funds, everyone, they were buying commodities when we knew inflation was hot and the Fed was behind the curve. Then the Fed started the most aggressive rate hiking campaign in over half a century, or roughly half a century, and back to the 70s. And that took the steam. So, the hedgies and institutions, everyone's, got away from the commodities for a while. And so now we know a rate cycle. The Fed has already clearly indicated that they're pivoting now. And so there will be that vicious cycle I've talked about, or a negative feedback loop. And you'll probably see a return to the inflation / commodity trade when sooner than later rate cuts are already baked in. So that's your update on wheat. All right, so a few individual stocks. Intel, still long-term play off long-term support, one of the better looking semis in my opinion. Still holding, again, the long-term support is this a 1930-ish level, and you've got the big divergence on the weekly, and that one, again, take a while to play out, but it's a beat down stock with a lot of goodwill in the name, a lot of, it's not going to go away. And then I gave you recently PayPal. That's not PayPal, PYPL. I can type here. PYPL was on the daily chart. We had this breakout back test. Broke the breakout that I highlighted recently. It was a break above 69, and it's been back testing that since I highlighted the breakout. So especially if the market goes up, still looking good to at least T1 all the way up to T3, T4. Right now, T3 is still the final target. And so if the market's got some juice in it, then yeah, this one should play out. Looks like one of the better ones. I also had the other last week, and I was busy at the time and didn't get it out to you. You can see here's my alert log. So you can see last week, for example, on the 22nd, when QQQ broke that first trend line, you had that there. I'll go over the financials in another video today, but these are the alerts I've had go off for the last week, and one of them was Peloton, and you can see it was on 8/22, which was right here, the day it broke out. So I believe I shared it in a video, but then I didn't. By the time at the end of the day, it was up so much and was already up to the 200-day moving averages. So I'm getting out to you now as one to buy on a pullback. You can see, again, the breakout right 9:30 a.m. right at the open. I think you can see that there. And that same day, you can see on 8/22, I created my first target here, 527. I didn't get that target out to you in a video. I think the setup was laid out to you recently, and we hit a high of 526, close enough for government work. And so it pulled back exactly where I figured it would. And so now any pullbacks to support, this 424 support, the 200-day moving averages are, you can see it got checked, the 200s there. It's finally broken above the 200s, and now it's back testing the 200s. You can see how the 200s have contained the stock. There's a run into the 200 exponential there, a run into the 200 simple, and that's where they gave them up right there. So there it is as a trade idea as well. Like I said, Sorry I didn't get that alert out to you. It was right there that morning too. It didn't run. It just had barely broken out, and there was plenty of juice from the breakout. This thing's already run up 54% to get to that first target I had there. But there's the next target. Again, this is contingent on the market holding up and those flags playing out. Maybe maybe even new highs on the indexes. New highs certainly. These are some of the better looking stocks. So that's what I'm showing you here. Bottoming plays. I'll do an update on that SMCI. So in yesterday's video, if you watched it, I told you as I was recording, and I even sent the company an email yesterday, a support, asked them to please add that feature because I constantly pause the videos. There's a little box, a recording box. You can't see it, obviously, in the screen when I'm recording these, but so when I cycle to the next security or the next chart, I'll pause it, collect my thoughts, make sure I'm on the right time frame, the right board. I have multiple boards on individual stocks, and then I'll resume. And sometimes that little click of the pause button doesn't take when I unpause it. And so where I'm going is I watched the video, but it was so clean because I always stop at one stock and then restart it again. I don't know where I really left off. So yesterday, and I did reply. You can see it in the comment section. Somebody asked for an update on the SMCI, which I, again, had covered extensively in yesterday's video, but that's when I happened to had the recording was paused, and I didn't realize that. But I did get a chart out and said, so what I've done, so if you recall, back here, it was first mentioned as a short there, several times since, and most recently I updated it on the 19th, right here. And I told you that covered all shorts and went hard long on the 5th, I think it was, the day we bottomed. Yeah, right there. And then we went on to hit this trend line and told you that this would be the re-entry zone right here. We had a beautiful gap. There was support on all these candles right there. We gapped down. We've been dancing along it all the way up to, but not above 690.46. You had a confluence of resistance. You had the 200-day simple and exponentials, which you can see it held here, tested, then gave them up. And you had this big gap, that box I showed you in the video right there. And so that was a relatively tight re-entry, objective short entry zone. And this thing never even got past it, couldn't even backfill the gap, rejected hard. And so here's what I did in yesterday's video, and then again in the comment section. So my sole price target initially was 355.60. And what I was saying in the video and what I said in that comment yesterday, in that reply to the comment, is I had a hard sole target at 355.60, but again, I always say I'm a flexible trader. There was no reason not to cover on August 5th when the bounce looked almost certain or very likely, and not just a bounce, a big, what I called explosive rally, double digit. And we got it. It was not small. It was a 28% bounce back in SMCI. But right now, let me get back to what I did. So that was a sold target. And I still maintain it's a big if NVIDIA resumes the next downtrend, and just NVIDIA alone. But yes, it'll take the semis in the market down with it. If that happens, then I modified from a sold price target of 355.60 to a first target zone favoring the bottom. That's a sizable difference from 355.60 down to 308.50. So if the market does roll over, we'll probably know by tomorrow, maybe later today. If these gains get faded right now, we're up about 1% on the Qs. That's a difference of an extra 12.61. And what I said in the video, when I have a target zone, if you're wondering how I trade it, if I'm leaning that way, but certainly recognize that's the first support level. And by the way, I call it a zone when I have two support levels on a short trade in close proximity. That's where I make it a zone, because you're likely to reverse anywhere from the top to the bottom. And so the way to trade it, if you want to just the highest probability trade, set a hard buy to cover order just above 355.60. I always cover a hair above support in case the buyers step in early. But what I'll tend to do on these is when you get close, then set a stop above relatively lower stops to allow for the move down. So worst case scenario, you hit it and you bounce there and you gave back a little. You didn't milk out every penny. But by lowering stops, and then if it goes down below, lower it again, and that way, and then you'd have a hard stop I'm sorry, buy to cover your short position to close it out just above 308.50. Again, if the charts confirm. And what I also did is gave you a second target, really a zone, but I'm going to leave it at T2 right there. It's a 232.71 again, and there's the bottom of it if we're really melting down at that point. So it's also a target zone, if you will. Right now, preferring the top again. That's if. There's a lot of big ifs. First if is going to be that NVDA resumes a downtrend, in the coming days, and if so, this one will most likely go on down and hit these deeper targets. I'll end it here with Carvana. Carvana, remember I've given you two. It's a short trade setup with two different trend lines. You have a primary comes off the late December 2022 lows, and that's this line right here. And that's the one that's probably going to do the trick. And a lot of reactions on it you can see along the way. And then I have a BOD trend line, benefit of the doubt, just below. It comes off these lows right here. I know it's a busy board here. I'll make it clean for you and draw them, replicate them. And I'll draw it with this tool. So you got this one here, come in like that. And then the one, well, I got to go all the way back out now again. The primary trend line right here. Okay, so this is the one with the most reactions, and that's the one that's probably going to do the trick. And so that's still a pretty aggressive target. The stock tends to move a lot. T4 is about a 72% drop if hit. T1, if hit, is about a 40% drop. But again, needs to take out that trend line, especially on a solid daily closing basis. We've seen plenty of whipsaws lately, and that's still a setup. And it's most likely going to take the market rolling over soon because it's like an economic play. If they're economy, stock market's going up, then everyone's going to harp on that Goldilocks scenario that the economy's strong. GDP came in today, wasn't too bad. Same with jobless claims expected. So the most optimal scenario for the stock market, and I can't argue this, if the economy stays strong, jobs stay, we don't see that continued uptick, but we've already turned the corner in the jobs market. I have no doubt about that. But again, we could take 2-3 months of it. It's just this narrative that the economy is actually on solid footing, and yet we're still going to get rate cuts. And that's the bull thesis. But however, watch these economic indicators, watch employment reports and everything else, and of course, most importantly, the charts. And that's if and when the market realizes that the only reason we're getting rate cuts is that a recession is pretty much inevitable, baked in the cake. Carvana's not selling a lot of cars. And I could go off fundamentally. There's a lot of stuff out there if you watch about the amount of cars being repossessed, coming back. You're going to see a flood of used cars coming back on the market that's going to offset, and that may play into Carvana or not. And I know they sell used cars, but we'll see what happens there. Either way, charts are the charts. There's your setup there. Oh, I know I'm still going. Last but not least, remember on crude, so I talked about the zones that I gave you months ago, and you haven't heard me talk much about the zones on treasury bonds lately because as I said back then, and this was the same thing I was warning, and this played out with impunity. Every time we got down here in the orange zone, I warned the stock market would take note. It did. We got a couple rejections there. We had the biggest corrections in the stock market, and again, the whole logic or point of this is these are treasury bond prices, which are inverse to yields. So when prices are going down, yields or interest rates are going up. And the 10-year is the most important one to watch. And all along, since I said this, I had a little caveat in there, an asterisk, that any advance due to a strong stock market sell-off will be a flight to safety in bid in net bearish, not bullish. And that's exactly what happened. So that's into the August 5th lows. And so it's what I said. It's not bullish for the economy. I mean, yes, falling interest rates are, but that rally was for the wrong reasons. It was not a natural, organic fall in rates. It was due to flight to safety bids. So point being, I'll continue to watch it. And I haven't talked much about treasuries because we had that, flight to safety ramp up there. But we do have now, from a technical perspective, we have the 10-year walking up this uptrend line. And so, yes, if rates pull back, we go back into the green zone, and it's still net bullish. It's the market's okay up here because, again, this is where we get down into the yellow zone, which is right here, or especially the orange zone, and God forbid the red zone, then that's where the market freaks out. So I'll watch it. Just want to throw it out there. And I've been watching the treasuries almost on a day. I always watch them. And I just don't see a strong trading up. I'd have no desire to trade them. In the past, I've traded them both as pure play longs or shorts, as well as indirect hedges to equity positions, be it long or short. But I do want to mention that we could start ticking back up. And with the Fed almost certainly cutting in September, that would be something to note. And what falling yields would show you, falling bond prices, rising yields might be a concern to the market. Not right away, something I'll continue to monitor. More so in the near term, I would have you, or I would tell you, I'll be monitoring the move in the dollar and the euro, because the more you disconnect with the stock market going up and the euro falling or the dollar rising, that's a disconnect that invariably always has resulted in mean reversions, meaning one or the other. If the stock market plays a game of catch up to the downside, or the euro plays a game of catch up to the upside. All right, I'm going to wrap it up here. We're right at the 40-minute mark. I'm going to collect my thoughts and then get some other videos out to you. I want to cover some things such as the financials, regional banks, and some other things I'm watching. This has been Randy Finney with Right Side of the Chart. Have a great day.